Oh boy, according to JP Morgan, they see portfolio rebalancing lifting US stocks 7% in this upcoming week. When you see a article like that, you gotta take a look, and that's what we're gonna do here in this video. Talk about portfolio rebalancing and how that can in a substantial way help out AMC stock. So before we get into it, check out the Budweiser hat, baby. Enjoy a cold one on me. Probably can't celebrate too much for the overall portfolio, but nonetheless, I think some gains are coming. So does JP Morgan. So let's dive into this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. Now let's get straight into it. So portfolio rebalancing. This is something that doesn't get enough credit during bull markets, but it does play a big role in how stocks move in bull markets and bear markets. But specifically when the NASDAQ is still down this much on the year, about 26-27%, it's going to play a big role on how these beaten down stocks such as AMC do trade. So let's talk about exactly what JP Morgan is seeing. Apparently they see a 7% rally in this upcoming week. That would consist of a couple very strong days at the very least. So June 24th, this came out yesterday, US equities could see a 7% move up next week as investors rebalance their portfolios after a brutal first half of the year, JP Morgan's chief global market strategist Marko Kolanovic said on Friday. Next week's marks the end of the month, second quarter, and the first half of the year, making for a busy time for investors with fixed weight portfolios who must rebalance their asset exposure to account for past market moves. Now, to make this really make sense, essentially what this is saying, hey, during a quarter, during a month, you can get people that get overly negative or people that get overly optimistic, and you can see stocks that get beaten down way too much or stocks that get bid up way too high. And essentially what this is taking a fresh look at the portfolio, saying what do we expect to do better or worse over the next 3 to 6 months. Now, I could make an argument for a bullish case and a bearish case, and as you guys know, I have been projecting this 5 to 10% rally from the lows, and that's exactly what we have seen so far, rallying about, give or take, 7.5% from the bottom. Now, JP Morgan and Marko Kolanovic, they expect 7% from where we closed on Friday. That would put the S&P at about roughly 417.87, about to where these levels we were at when I called out essentially the negativity that was going to come in the stock market. And that is essentially what ended up happening. We got a very negative overall market reaction. Over the next week or so, the markets fell over 10%. So if you guys want access to all of my trades in real time, link down below in the pinned comment. The prices will be going up tonight. I know it's been 2 days and I've said that, but they will be going up tonight to start off a fresh trading week and to hopefully hit some big home runs in this week and the next following weeks. And specifically, when the markets do continue to rally and they get back up to these prices, we will come down and hit lower lows. So I do think that's where a massive opportunity will actually sit for us. But now, how is this really important for AMC? And that's what I want to talk about right now. So when you're looking at your portfolio, when you're taking a fresh look at these stocks that you own, whether you have short positions on them, whether you are long on them, I think when people look at AMC in particular, they're going to say, hey, this stock is beaten into the ground. Now, the whole time AMC, well, I should say the overall markets were falling like this, AMC was not. AMC's chart was not looking like this at all. You guys will see right here. It's been flat. And that's a bullish thing. That's actually a very bullish thing when the markets are hitting lower lows and AMC is not. People argue and want to, you know, call out the fact that AMC is not ripping to the fucking stratosphere right now. But as long as we are not cratering through the floor at the same time the markets are, that is bullish. Usually when that happens, you're going to see AMC react much better during the uptrend. And I just think when hedge funds look at their portfolio, they're going to say, we have squeezed out so much of the potential gain to the downside. There's not too far left to actually go to the downside. And I think that's why Ray Dalio, Bridgewater Capital, just initiated a brand new position on AMC. I think that's why Citadel doubled their net long exposure to AMC, and why the Swiss bank continues to add millions of shares every single quarter of AMC stock, as well as other hedge funds, is because the risk to reward profile on AMC doesn't make sense to continue to short the stock. You could argue there's much better stocks to actually short than AMC stock. And why do I say that? It's because AMC is in a weird, call it a weird segment of the markets, where over the last 2 years has not performed very well. Your travel sectors, right? People were spending a lot of money on goods. A lot of these companies were, quote unquote, going to go bankrupt over the last 2 years. Well, AMC in the last 2 years has not been doing so well. Well, now you are starting to see blockbuster after blockbuster movie coming out, and people are going to theaters. There has been this shift in the way that people spend money, like I said, from goods to services, and that is likely to last for an extended period of time. At the same time, over the past 2 years, AMC has not just folded their hands and just said, hey, you know, we are what we are. If the business fails, the business fails. No, they have been initiating brand new programs like their popcorn business, like their credit card business, like their crypto business, which is all to come in the second half of 2022. So if you're looking at AMC and you're saying, hey, what are the odds of this thing falling 50% down to say $6, or the odds of this thing going up to, let's say, $16, $17, $18 and going up 50% from here? Well, the obvious answer is it's more than likely to go up from here. Even if you look at AMC on a purely fundamental basis, and we go ahead and pull this up, AMC is only at about a 1 price to sales ratio. And the biggest thing right now is profits. That's what investors care about. And that's why people say that, hey, AMC could fall to $5 or $6 per share because of they're not profitable. Well, I would argue differently, because the way that I see it is those other added business sectors, right? The credit card, the crypto, the popcorn business, that's all extra. But AMC has had a real opportunity over the last 2 years to get their profits in line. Even what they have been doing with refinancing some of their notes that are that 10 to 15% interest rate, which is just unsustainable, unsustainable. They've had an opportunity to really cut back the fat of their business and hopefully get their profit margins in line with a normal theater business. AMC has had terrible profit margins long before COVID. 2% profit margin in a good year, that's where AMC sat. Whereas Cinemark, something that was created, or that business I should say, created and founded in the 1980s, had a lot less fat on the business. They would shut down theaters that were bad, open good theaters much more frequently, whereas AMC had a lot of historical theaters, had a lot of locations that were not so profitable. Cinemark returned a 6% profit in a good year and still returned a 3 to 4% profit in a bad year, whereas AMC would return a 2% profit in a good year and lose 2% in a bad year. So if AMC can just get their profit margins good, they have the volume, they have everything else going for them, and you could potentially see hundreds of millions of dollars in profits for 2022 for the back half and for 2023, and that's going to force investors to value AMC a lot higher. So long story short, I think when hedge funds look at their portfolio and say, hey, should we be short in this stock or should we be long in this stock? The overwhelming answer is you should not be short on this stock. If you want to go long on this stock, it's not a bad bet, considering people are going to continue to spend money on services rather than on goods and products. So let's continue on with this article to give you guys the full overview of what Marko Kolanovic is saying, but that's really from my perspective, why I think this could be a very bullish thing for AMC stock and why I think AMC stock could indeed go crazy in this next upcoming week. So continuing on with this article, it says, while these rebalances typically do not tend to become main drivers for markets, they can assume a more important role when markets move over rebalance windows where large and in the same direction, as in the case now. JP Morgan's strategist led by Kolanovic said in a note on Friday. The S&P 500 is down 14% for the quarter to date period and down 18% for the year as investors have been spooked by aggressive Federal Reserve interest rate hikes aimed at curbing surging inflation. Meanwhile, bonds which offer investors secure in times of volatility have also sold off as rising inflation unsettled investors. So what they're saying is even during this quarter, that's where you have seen most of the loss on the S&P 500 for the whole entire year. So when investors look at their portfolios, basically what I said, it doesn't make sense to be short on a lot of these stocks, and a lot of stocks do deserve to be bought at these prices. Now he says, quote, on top of that, the markets is in an oversold condition. Cash balances are at record levels and recent market shorting activity reached levels not seen since 2008, Kolanovic said. Based on how markets reacted during recent rebalancing, including at the end of the first quarter and near the end of May, when stocks paired losses at the quarter and the month-end periods approach, Kolanovic expects equities to rise 7% next week and bonds to feel moderate downward pressure. Of course, rebalances are not the only drivers, and the estimated move is assuming all else equal. So he's basically saying as long as everything else goes as planned and we don't get any big market surprises, stocks should rally about 7% next week. And I'm kind of in line with that. You know, for next week, you don't have anything too crazy that's going to move the markets. On Thursday, you do have personal income month over month, personal spending month over month, PCE price index, which that's going to be very important. That is the main thing the Fed looks at as far as inflation. And then on Friday, you do have ISM manufacturing data, but you still have Monday, Tuesday, and Wednesday to see some pretty big gains, especially when you look at the S&P and what happened towards the end of trading on Friday. You absolutely ripped into the close. So I think that right there is a very bullish sign. And obviously what happened on Friday as well, you had the inflation expectations for the Michigan Consumer Sentiment Survey come in very well, and that is what helped to give us this rally in the beginning of trading and help sustain us and not really see those crazy down moves, crazy up moves. It was really a gap up and then a gap up. The first gap up was based off of the Fed stress test. So it was an overall solid day on Friday. Even into the close, after hours was slightly down, but you can see this upward trajectory. Now, I do want to say the real market opportunity is still to come, and that is playing the downside, because even though we could see a 7% rally this week, we're still in for more pain over the next month or two. And I do think that is around July 28th. So if we do get a 7% move from here, you know, that would put us in the 417 range. That's where you are really going to get that opportunity to play the downside. And why I do think there will be downside is because the Fed is going to be raising rates on July 27th. Expected a 50 basis point rate hike. We might get a 75 basis point rate hike depending on what markets expect. The Fed's going to do whatever the markets price in. But right now we're only expecting a 50 basis point rate hike. And then the next day, July 28th, we get the advanced estimates for Q2 GDP. Now, on a slightly different note here, you know it's bad when you scroll on Facebook and people are talking about the government is more worried about Roe v. Wade than the fact that we are in a recession. When regular people on Facebook are talking about a recession that do not own a single stock, that's where you know things are not good. And that's where the downside will come, is when markets expect, and I've said this a couple times, but I'll keep saying it because this is where the opportunity is, in my opinion, for 2022, at least for a trade. When the markets realize the Fed is going to continue to raise rates because inflation is too high, at the same time we are in a recession. That means pain for the stock market. There's no other way to put it. Add on top of that quantitative tightening, add on top of that the global wars we're seeing going on right now, the global tensions, and you're in for, let's just call it, a shit show. So that is what I have for you guys here in this video. If you guys found value out of it, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock with Webull, Moomoo, and Public. As well as that, like I said, prices will be going up for the trading community. If you guys want access to those trades, link down below in the pinned comment. Come ask questions, any questions you have, certain strategies, whatever you want to know. That is your tool to use for your benefit. And let's get that money, baby. It is time. 2022. We have no time to wait. Yeah, so thank you guys for tuning in. You guys enjoy the rest of your weekend. Have a Budweiser on me. I will see you in the next one.